And this one is another speed round, and we have a moderator. You saw him on stage on one of these chairs. Now he's going to be taking my spot here. This is Mark Halpern, and Mark is a private investor whose primary occupation is breakthrough catalyst R&D, and he diversifies his passive placement portfolio by investing in multiple projects. And I think he's going to tell us a little bit more about that as we go through each of these different ones. It's a speed panel. Hope you enjoy, and everyone, a little round of applause for panel 7.
Yeah, this is going to be a really great panel. I want to thank Richard Wilson and the team for putting this together as one of the topics. I think it's a really great topic. It's going to be really, really great for both sponsors and investors, because we're going to be hearing what people's portfolios are, or your organization's portfolios are, and maybe even how they've changed and how they're going to change as things are happening here. My name is Mark Halpern from Deep Due Diligence Investors. What we do is we have a group of investors that we perform joint deep due diligence together. And as a result of what's happened in the marketplace, okay. Yeah. So as a result of what's happened in the in macroeconomics, mostly when the Fed raised the rates from March of 2022 to July of 23, a lot of things have changed. And of course, in the last few weeks, a lot of macroeconomics have changed. So that in our group of investors, we are debating what it is that how we should change our portfolio, the composition of our portfolios. These guys here are bigger time investors than we are, so it'll be interesting to see what you guys are going to say about your portfolio composition. And by the way, just for the sponsors, if any of you have any pitch decks that you want to upload, you can go to the Hoop app, look up my name, and you can put it down from duediligenceclub.com, and it's free, just to get exposure to our group. So what we're going to be doing, a little bit different than some of the other panels, is we're going to actually be doing this in 5-minute blocks. Everybody's going to have a block, as opposed to asking one question and going down. So maybe we'll start, and it'll be all the same questions for everybody. The first thing we'll do is just have everybody introduce themselves. So Patrick,
Sure.
And introduce yourself, and then afterwards I'll ask you a bunch of questions.
Sure. My name is Patrick O'Meara. I'm founder and CEO of my family office, Patrick Ventures. We're in Scottsdale, Arizona.
Sasha Bernier, managing partner of Hestia Holdings, in which Cheltenham Investors, a family office, is a part of.
Good morning. My name is Ken Hoyer with Kidd & Company. We're a family office focused on making control investments into operating businesses in the lower middle market, typically with less than 10 million of EBITDA.
My name is Jeremiah White, and I am the founder of White Sport Ventures, and we invest in soccer-specific ventures in media, technology, and real estate.
Good morning, everybody. I'm Jody Chapnick. I have my own single-family office. I want to introduce you to my daughter, Sarah, over there. She's acting as my bodyguard right now, and I'm hoping she'll be the stewardess of my capital one day.
Wow, that's
I'm in
impressive.
real estate and private equity. So I've been involved in a REIT and 2 pharmaceutical companies and 2 insurance underwriters.
Just a general comment, Rich was always saying, bring your kids and grandkids, and it's really great to see that. That's really fantastic. Okay, so we're going to do this 5 minutes each on a few questions. Actually, I'll tell you what the questions are first, and then I can remind you as we're going around. So the first thing is, what do you typically invest in right now? Sort of like, what is the composition of your current portfolio? And then the other question is going to be, what are you looking for? Especially since we have a lot of sponsors out there that can provide you with what it is that you're looking for, and also be if what you're looking for is different than what your current composition is, then why have your decisions are changing? Like, is it macroeconomics, or something has changed in you, something has changed in the marketplace? And then in the end, I'm going to ask you this. The last question is about the $1 million insight. So let's go for that.
Well, that's a lot. All right. So
the first one is, what's the composition of your current portfolio?
Sure. So I've been in commercial real estate and finance for almost 30 years. So the majority of my portfolio is commercial real estate and finance. We're in technology and consumer products. The technology is we want to go for some moonshots and try to get, the 5 and 10x and type things. We're in venture and PE. Just look for opportunities with great people doing great things.
Okay. And going forward, you made a great presentation to our group yesterday, so I have a pretty good idea. But just everybody else, what are you looking to do? What are you looking to invest going forward?
Well, some of our primary objectives, some are more active things where we're a part of either ownership structure or we move from an LP to GP for things, or we have a United Tiny Home Manufacturing Company, a hedge fund. We have this interesting laundry sauce consumer products company. We're part of a bank and a few other credit facilities, but our senior housing, I think you saw my presentation yesterday, is near and dear to me. We're building senior housing on Catholic Church land, and it's just hitting that, generational need that we want to do. I know the next question you're asking is that, what do I want to get into, if you like. So it's funny, our portfolio is a tale of two cities. I got one city that's doing fantastic, it's growing, it's booming, doing really good, or just, it's projecting what it's supposed to be projecting. And the other one's literally on fire. It's an absolute dumpster fire for a lot of stuff been happening. And so we've been just battling it. And I feel like I'm stealing water from the good city to pour down to take care of the fires on the bad city. And it's mainly because the last 4 years have been so difficult because of inflation and interest rates. A lot of our businesses were tied to and got caught with interest rates increased so rapidly, whether it be our real estate portfolio, whether it be a transaction velocity and asset sales, or even our manufacturing company with inflation materials. And so diversifying going forward, what I'm looking for is more cash flow businesses to provide income to us. I like, the lower middle market is an idea for us. What I'm looking for is that what fits in with my current ecosystem that we can add value to that. So again, we're commercial real estate experts. The financing side of it, I like, the credit markets, private credit's great. We had a private equity fund at one time. We've had a couple other really unique things in the lending and fintech space, which I like. But it's been a very interesting journey. I will tell you that. I really am not bullish for the rest of the year of what it looks like. I think it's going to be a lot of turmoil. Obviously, the presidency has been, whatever you like, right or wrong, but at least we have an idea of what the economy might look like, but it's still going to be very, very choppy because things keep changing. And so it's changing our investment philosophy to be more stable, and I'm pulling out of more venture. We, just like other family offices, are stuck in venture. We are just have no exits. There's nothing in sight. The IPO market last year was the single worst IPO market since 2008. You've got a lot of credit card defaults. You've got a lot of repos in the auto market. And so the consumers are getting crushed in this marketplace. And so we just got to pay attention to where our next investment strategy should be.
Excellent. Well, in the 55 seconds left, would you like to share your number one most valuable $1 million insight?
So Kevin, who was on the Fireside earlier, said it best where, if I'm looking at opportunities in the marketplace and people are coming up to me because we get a lot of deal flow, because of all the things that we're involved in. If people bring us opportunities, please be prepared. Please understand what the marketplace, please know what we're doing. Take a look at, does it fit within ourselves? Don't try to jam something in, a square peg in a round hole. Have your understanding of what your business plan is or what you're trying to accomplish, and have a realistic approach of what the capital requirement needs are. Things changed when two of the largest banks fell apart, SVB and Republic, 3 years ago. Angel investing and seed investing is completely different than it was back then. And with your seed investment, just to wrap it up, is that you need to have revenue now. We've got to show some profitability. The scarcity of liquidity is a big thing. So just kind of have that as knowledge.
Excellent. Wow, great insights. Thank you. Sasha, so what is
Can I leave now? Can I leave now?
No, you're holding your captive. Sasha, so what is your composition now? And
Yeah. I started our new venture in 2021, which was probably the worst year to start. And the family that backed us, the mandate was literally make a lot of money and don't lose it, right? We were afraid coming out the gate because we had to prove the concept to the family, and we were fortunate that we started off just being very diversified, right? So each major bucket, private equity, real estate, lending, and venture, we decided that no one bucket was going to exceed more than 25%. And we started with venture, and as he was saying, it was the worst possible time to start because rates started accelerating. But the good thing, though, is as time progressed, the good thing that happened with rates were all the people, because we tend to support what we call independent sponsors, sub-institutional deals where big capital doesn't go in. All the capital, for instance, if in between 2015, 2021, you must have met 100 syndicators of real estate every day, right? Like it could have gone to your barbershop, whoever, they were a syndicator of real estate, right? And at that time, what happened was with a lot of those people doing those type of deals, they didn't really have experience and they weren't really bringing in value and they were just relying on, make a few changes and then sell on to the next person, right? But never understanding that if rates accelerated or moved, you really needed to have a skill set. And so during that acceleration period, you really separated the weak from the strong and those who really had actual skill sets, right? The thing is, it was difficult because you really had to, we hadn't had normal rates since essentially 08, 09, so you really had to do a little bit more work. So there were more opportunities to really find value as you transitioned through that period. The difficulty was, though, is okay, so you found all these good opportunities, but at the same time, though, there really isn't any exits, right? Like that's been, the most difficult aspect. There's been a disconnect between the public markets and what you're really seeing in the private markets. And even today, right, you see tariffs on, tariffs off, tariffs on, tariffs off, right? And so the market does this, right? And it's not translating into two things. You're not seeing a movement in the private markets, and you're not really. The one consistent thing that's standard that you're seeing is if you look at the bond market, it stayed steady, right? And that's really at the end of the day, the 10-year is a measure of 99% of where things are, and it's scary, right? If you look at the 10-year, I think that's the volatility and all those things that we're seeing. That's problematic right now, right? And I think that's what you're going to have to watch. And when you're making your investment decisions, right, down the line, that's going to affect so many different things. And when you see that, foreign countries that make up a third of treasuries who aren't buying, that's going to affect every asset class, regardless of what it is. Real estate, private equity, right, when you need to refinance and things of that nature. So I think right now it's just the best thing to do is just be conservative. No need to hit home runs. Really focus on, if you can't get liquidity, how do you get cash? So two of the things that I've been focused on right now is looking for people who are rolling up simple asset classes, right? That if there is no exit, we get cash flows. For instance, the laundromats. There's one person that's just rolling up that we've invested that's rolling up laundromats. I know there's cash flow. People will always need to wash their clothes. Hotels will need to wash stuff. So really simple things like that. And then on the real estate side, it's been hard to tell like where multi is going to be going because I think there's like a lot of volatility there. But we've been in the iOS space, industrial outdoor storage. Kind of got that by accident. It was a sponsor that we found, bought industrial properties, and then specifically in Florida, we were getting calls to if people could put their equipment outside. And I was like, oh, that sounds great. We're getting extra rent. And then I found out that there was actually a space as we started buying, we were getting calls. I was like, oh, that's interesting. And so, again, that's sub-institutional, right? You're not big players. They're not going to get in there so you can get a good price, you get cash flow, and then maybe you get an exit through a 1031 exchange. And so really like simple businesses right now, we're not trying to hit up the home runs because, and then as they were saying earlier, just like looking for sponsors who really have good experience because you're going to find out a lot during these period of time.
Happen to agree with all the things you said. That's great. Later when we go out in the hall, people can get the $1 million insights because we ran out of time, but it was great content. Ken.
Good morning again. We're focused on control investments of small businesses in the U.S., really across all industries. And The good news is there are hundreds of thousands of companies, have a great product or service being run by the founders today. And left to their own devices, they'll continue to be good small businesses. But a lot of these business owners, you hear the graying of America. They don't have a well thought out exit or plan for transitioning their company over time. And they might be in industries where some outside catalysts, in addition to capital, some general business building capabilities, some professionalism and expansion of the management team. Perhaps it's a fragmented industry where you can look at acquiring multiple businesses. The things that we look for across all industries are those fragmented aspects of the competitive landscape, and where you can get in and buy these small companies at very reasonable valuations. I still think it's the most inefficient segment of the market in terms of valuations. A lot of private equity capital and private equity funds are out there chasing deals, and they'd have to do too many transactions to buy the types of businesses that we do. So we get in as the first outside capital in partnership with these business owners. We give them a meaningful liquidity event. We're buying at least 51% of their company. But ideally, we want them to stay involved not only as operators along with us, but as shareholders, because together we're going to build something larger and more valuable over time that hopefully they couldn't do on their own. We also listen to them in terms of what are the things that they enjoy about running their companies, and what are the things today that they're doing out of necessity, but they don't particularly enjoy. The HR, the finance, the admin. A lot of these entrepreneurs, we've seen them, they're stretched very thin. They've got a great product or service. They're running around with their hair on fire, troubleshooting and dealing with challenges and problems. And they pick their head up and now they haven't really thought about, how are they going to transition their company, or, they might have, 50% or more customer concentration because they're just, answering the phone and responding to customer service. Those are great attributes. These are good small companies, and I call them diamonds in the rough. I mean, they're basically, just looking for some outside support and assistance. And, we think we're the guys that can come in and, as general business builders, provide the right catalyst, give them the human resources, the capital, again, to be successful at a different level. So today we've got 3 active portfolio investments. We're in landscape services, where we've made 8 acquisitions in the southeastern U.S., building a larger company. Again, we look for opportunities where we can get in and buy small companies that, call it plus or minus 4 or 5 times EBITDA. Resulting companies a little bit larger than what we've built today are trading at 13 to 15 times. And I like to say, I used to do early stage venture. That's very hard. I think in the world that we play in, we can make venture-like returns without taking venture-like risk and dealing with, are you going to have a product? Are you going to generate revenue? And so it's been a very compelling segment of the market. Bill Kidd, my partner, started doing this almost 50 years ago. Made his first investment into a privately owned company, and the rest is history. A lot of his colleagues, at the time went out and, based on their success, were able to raise large, multi-billion-dollar private equity funds. And, private equity funds are still the large, part of how capital gets deployed into private companies. But, we think at the lower end of the middle market, we can do better economically by just investing our own capital on a deal-by-deal basis.
So before I ask you for the $1 million insight, if there's even one founder out there that's getting to the point where, hey, there's stuff that you don't want to do it, but you have the passion for the rest of it, you got to see Ken afterwards.
Thanks for that.
$1 million insight.
$1 million insight. Again, I think, based on what we do, the landscape is fertile for the types of companies and the opportunities. Again, hundreds of thousands of companies that fit the description of what I just described. The challenge is, we're out there trying to boil the ocean every day. And so I would say we lean pretty heavily on seasoned executives that we can network with and partner with that have had experience in medical device manufacturing or landscape services or IT services. And we partner with them and we come up with an investment strategy, and then we go out together and we find companies that are in their industry and area of expertise. And a lot of those business owners are going to rather talk to this gentleman, that I'm partnered with, because he's got the credibility and the experience in their industry, and we're just, trying to facilitate it. And so I think it's about kind of knowing what you don't know and knowing where you need extra support and expertise, particularly around the industry expertise, because that's not our strength. So.
Excellent. You have 10 seconds left. I've had the pleasure of meeting with Jeremiah a couple of times for a few hours. Really fascinating guy. And now you're going to tell the rest of the universe, or the galaxy at least, what it is that you're invested in right now and what you're going to be looking for in the future.
Right, already. So, good morning, everyone. All right. Any soccer fans here? Yeah, we ready for the Club World Cup? We ready for the World Cup? Because I am. This is like, I'm a former professional soccer player, so this is like my heaven coming up. So I'm invested specifically in soccer ventures. I mean, I played for the U.S. national team, played in Europe. I'm the first American who played in the Saudi Pro League. So this trend that we're sort of experiencing, I saw it coming a while ago. So I started to put my money, my investments, my resources in position to capitalize on it. So I started with media. And basically what I did was I took creatives and wrapped business services around them, similar to kind of how your approach. Wrapped business services around them because I knew I would need distribution into these different markets around the country. And in 2 years, I think we're up to over one of my the companies I've invested in. The founder of Footy Access is right there, but we're up to we generated about 500 million views in less than 2 years, with a really high engagement rate. But what that meant was I could then invest in other companies and deploy them and introduce them to the customer, to the end customer, through those distribution channels. So I'm currently invested. I own 2 teams. I own a team in MLS Next Pro out of the Bay called the Town FC. I don't know if any of you are in the Bay, but go check out a game. I'm an owner of Atlantic City FC. And right now we're in negotiations with the state of New Jersey to build a stadium on the ocean front. I'm an investor in a few AI companies, a financial service company, where we're scraping all of the data for youth soccer clubs around the country, whether they own their fields, whether they own their coach, how many of their coaches have coaching licenses, their players, and then their social media information. We're giving them financial scores. We're giving them social scores so that people who are trying to do business with these clubs can actually make informed decisions about how they approach them. And the reason we're focused on these clubs is because a lot of you, how many of you have kids that play youth soccer and are youth sports? And you know a lot of these clubs are very cash heavy, but poorly run. So and it's incredible to see the difference in the experience of the kid and the parent when minor adjustments are made and their experiences gets better. And when you make investments and improvements in the facilities, how the value of those clubs increases. So a lot of private equity is buying up. They're buying up a bunch of clubs, doing roll-ups, and they're coming to me and saying, "Hey, is this interesting to you?" One, because you know how to make those improvements in these clubs, number one. And number two, you have the distribution to broadcast the information about the clubs, market the players, et cetera, et cetera. The other phase of, I want to keep going, but do you?
Yeah, we got the,
Okay. Okay,
whatever
brilliant,
you wanna say,
brilliant.
it's great.
Brilliant. The other aspect of this is soccer players and professional players, because I mean both parts of the game, they need health services. They need there are a lot of businesses where their target market and their target customer is actually this particular demographic, and it's not obvious, but it's shocking the degree to which a lot of companies in financial services, healthcare, like you have you're invested in a lawn care, 8 lawn care facilities. They all have grass to cut, right? So there are, what I'm working on now is connecting folks to these opportunities through particularly this financial service platform I've built. But it's the main question I have is, and the main problem I'm solving for is how to connect investors and service providers to these opportunities in these clubs that are that have been traditionally difficult to access. So that's kind of where I'm at right now.
Before we go to Jody, I want to congratulate you for being here, because this is the only place that I know where you can come and you can hear about lawn care, senior housing, soccer, making plastic out of sugarcane.
That's fine.
And not just real estate. So for me, I love coming to these places because I love to hear this kind of perspective. The founders, this is just great. Jody.
I wasn't I wasn't a soccer player, but I've had a couple of big goals in my life. And so my background, what I've done in the past, I was a partner in a public REIT. We had about 10,000 apartments, bought everything off market, don't go through brokers. Valuations get out of control when you get a third party involved. And then I bought 2 pharmaceutical companies. One of them was a Grand Slam home run. I paid $18 million and we ended up selling it for $250 million, and we got about $108 million of cash flow. And then I started a second company, which was in consumer goods, and we would make kitty litter, and we had a big contract out of the box with Clorox, and kitty litter would last a day or two, and we put our product in the kitty litter, it would last 2 to 4 days. And we did the same thing with roll-on antiperspirant for Procter & Gamble. So when you go play some soccer and you sweat, it would last longer. So did that, and then I'm not as innovative as I am a copycat. I decided to copy Warren Buffett, and I bought 2 insurance underwriters, and very successfully, I paid $250 million for both companies. One was a 50-state homeowners company, and the second one was a garbage landfill company. So Waste Management would take their garbage to the dumps, and we would insure against fire or explosions. So I knew real estate, but I made a lot more money in private equity. So I was making 30x returns, 20x returns. I said, I don't want 15% in real estate. I'll just keep going for the swinging for the fences. So sold it off. My last exit, and I've had about 6 exits, but my last exit was in 21. So I've spent the last 3 years going to the beach. That's not true, but I live near the beach, and I spend my day every day looking for niche kinds of transactions. So I found one, and it happened to be the Carolina Panther NFL football team. And for sure, I thought we were going to buy the team. So we put a little group together, and we bid $2.5 billion. And, it's looking really good until a hedge fund guy came in, Mr. Tepper, and he offered $2.3 billion. And believe it or not, his lower bid won the team. And why did it win the team? Because we were 10 hacker guys, 10 of our friends, and he was one guy, and the NFL only wanted one guy. They've since changed, and we lost. It's too bad because the valuations have doubled in 3 to 4 years. So anyway, I look for monopoly situations, oligopoly. I'll look at an NFL team. I'll buy an airline. I'll buy an airline hangar. There's not many airlines. They all merged, so there's probably a half a dozen of them left. So if Delta Airlines is up for sale, let me know. I'll buy it if I can afford it or get it at the right price. So I bought the insurance company. I learned a lot from Buffett, and I spend my day every day copying him and looking to buy companies just like what he does. So people ask me all the time, what do you want to buy? And I said, if it's good enough for Warren Buffett, it's good enough for me. But it's going to be too small, the kind of companies I'm looking at, for Buffett to buy. So, I want great management. I want skin in the game. And one thing I found out, as private equity over here will tell you, valuations are so out of control. That's why I've been to the beach for the last 3 years. And it's really hard to buy a company because private equity is going to pay more. So what I'm trying to do now is buy 50% of a company, keep management in. They're not ready to go. They want some money. They could, give some to their wife, their girlfriend, or whatever. And I've had some success. I'm looking at some managing general agencies in the insurance business. So there's a situation where a guy just got divorced, and I think he's going to sell us half of the company, at a fair price as opposed to 16 times earnings. And I think there's a real opportunity. So I've got a tremendous liquidity, and I'm on the sidelines waiting to pounce as soon as I can.
This is the reason we come to these meetings. You have to come to all these meetings. It's just, these insights are really fantastic. We probably don't have time for questions, right?
I think that's let's get one question.
Anybody want to ask a question over there?
So my question's for Ken.
Thank you. Hi, Ken. I'm Gary Feldman from Cleveland, Ohio, and I'm running about 7 different companies, including my family businesses from 1956, small businesses. And I'm working with a whole different bunch of people, different age groups, etc. Do you use technology to get to know people from the inside versus more of how we perceive them from the outside? So, for example, if you're taking 51% of a small business company, do you consider that the people you're working with might have high autonomy and want to run their own gigs? And they might need to be supported by complementary personalities to synergize beyond what the individual would do, beyond the industries and the markets that they've been identifying with?
Yeah, I mean, what you're talking about is probably the most challenging thing to get right, is that, the personality and relationship alignment at the lower end of the middle market. I was talking to a private equity fund principal not too long ago, and they were trying to establish some sort of correlation between their returns and what they paid for businesses, how long they owned it, and what they came to the realization is the companies that they did the best with from a return perspective were the ones where they got to know the management team and the ownership the longest. So if you think about an investment bank that's coming and they're running a process and they're going out to 250 people and they want IOIs by next Friday, and they're going to invite 12 groups in for management meetings, and they're like, how quickly can you close? How quickly can you close? Quite frankly, that's not a fit for us. We've spent time, sometimes 6 months, 12 months, getting to know business owners, not because they're for sale, but just because we were introduced to them or we learned about their company, and we're really trying to identify, is this a person that we want to be in business with? Do we think they can be helpful? And so I think at the beginning of your question, you asked, do we use technology to figure out sort of personalities or whether we're going to fit with them? I don't know that tech. I'd like to know if there is a technology
So I
that's
have that
proven.
technology, and within 10 minutes, I'll know your personality.
Okay. Well,
And
maybe
everyone else's. So.
we should catch up outdoors. But I
And
think
it's part of a
that
global community that I'm developing to connect great people around the world.
you're all hitting on just the importance of getting to know the people you're getting into business with, because it's a marriage. It's not just a short-term courting. So.
Thank you.
I'll just make a comment. Richard Wilson developed an AI tool. It's called, I think, Partner Profile. Is that right? And I ran it on myself, and it gave me my Myers-Briggs and DISC and all kinds of stuff, and I learned who I was. But in the end, when it comes to investing, and this is just my personal perspective, AI is great for saving time, but in the end, AI is not writing the check. I'm writing the check. So I sort of rely on my human judgment at the very end, although AI definitely helps. So, but I'm not an expert in AI. I'm a chemist. What do I know? I shouldn't even be up here. Thank you very much. This is a great panel, and we'll see you at the next panel.
No problem.